Now the same effectively works within the income tax system. And within the income tax system in South Africa, we've got a section number by the name of Section 23M. And Section 23M deals with salary income. And when it comes to salary income in South Africa, there's certain deductions that you're allowed to make. First and foremost, there is pension and retirement annuities, in other words, retirement funds. So, in other words, the contributions that you make to your retirement funds, you're allowed to deduct from your income for the calculating of your income tax, because when you receive the income from those retirement funds after you retire, that income will then again be taxed in your hands. So it's just a case of deferring the tax from now until later. That's all. Then next up is donations to certain public benefit organizations. Those donations to public benefit organizations are deductible for tax purposes. Then there's your contributions to private medical funds, your privately spent out-of-pocket medical expenses. Then there is motor vehicle expenses if you have a motor vehicle allowance, and bad debts specifically relating to salary. In other words, if one of your salary checks bounces, then you don't get taxed on the money that you didn't receive. However, all of these over here, there are terms and conditions apply. Each one of these four additional factors, there are certain regulations, certain limitations that make it more difficult to be able to make adequate claims as far as these are concerned. You're certainly not getting a maximum tax benefit over here. For instance, as far as motor vehicle expenses against a motor vehicle allowance, the best that you can possibly hope to achieve is maybe 25 cents to 30 cents on each rand that you spend relating to that motor vehicle. So we can't exactly say that motor vehicles are a major advantage. So that's Section 23M dealing with salary income. And this is where the vast majority of everybody sits. Then on this side over here you have Section 11A, which is read together with Section 23G. That's just my terminology. And this deals with business and trade. And for this to be able to work, and I'm not saying that you're ignoring your salary income, but this is where the people play with a full field. In other words, look at a salary income together with a business or trade happening on the side. And for that to be viable, there needs to be a trade. In other words, it needs to generate some sort of cash flow. That's first and foremost. It needs to generate cash flow. Then, if you're generating cash flow, then you got expenses relating to generating that cash flow that happened during the tax year that can be seen as being needing to be spent in order to be able to produce that income, that are not of a capital nature. Capital nature is buying things like computers and motor vehicles and such like. However, you've got wear and tear on those items and other expenses relating to those items that will be able to be claimed against that, and it needs to be for the purposes of trade. And most importantly, there's case law saying that the expenses aren't necessarily limited to purely cash payments. In other words, if you bought something on account, you can claim that expense on account against the income that's generated, even if you're paying that account at a later date. So it's not limited to physical cash payments, and in some instances people buy large items and pay for those items using shares in a company. In other words, it's not a transfer of cash, but it's a transfer of something of value. So therefore, it's not limited to cash, bartering and such like. If you can put a value on that, you can claim that type of expenses. Now, how does this all work together?